Hello, investors. Welcome back to the channel. My name is Jake. I am the manager here on the Snake Skin Financial channel. And essentially, a lot of people have been asking me for a while, what do you actually do with your investments? Like, what are we actually looking at? What does your portfolios look like? And really, I have a lot of diversified holdings. Essentially, I did start a Robinhood account a while ago because I like Robinhood's tools and its ease of access and its ability for me to be able to do one thing and another thing really quickly and easily. And also just the fact that it's free. Pretty much any investment I've made in the past year, I started basically outside of anything I already had through my 401ks through my company. I basically started funneling into my Robinhood account because I thought it was so much better, more efficient, way simpler as far as me being able to do X and Y efficiently. And so I started up an account with basically about $100, and I started funneling a little bit of money in here or there over time. And I wanted to basically start showing off my portfolio to you, not so much to show off, but more or less to keep you in the loop about what I'm doing and what I'm holding in a more public and accountable setting, so that way you can go, maybe I do want to listen to this guy, or maybe this guy's an idiot. And both of those are valid points because honestly, I do things in a very slow-moving fashion. It's a fashion that mitigates a lot of risk, but at the same time is very slow moving compared to how some investors want to go about. Right now, I am doing this during trading hours, so you might see some things moving up and down as we do this. But anyway, guys, let's start off from the top of the portfolio, and we'll kind of move on down as far as my holdings go. One of the biggest holdings is actually in Ford. I do have an average cost that is still above $10.72. I bought most of my shares. I didn't buy most of my shares at this price, but I got a lot of my shares, about 30 or so of my shares when it was around $12. And then I mitigated my risk a lot by buying quite a few shares when it was around $9 or $8. It was something I was very, very happy with. Let's see right here. I bought 10 shares around $8.74, and I was basically buying down my cost. So that way, over time, it would basically even out a lot better. It's worked out very well for me. I've still lost money on the cost basis, but I've made money on the dividend basis over time with Ford. And Ford, being that it's a cyclical stock, it's one that I'm okay with long term. It's one that I don't think long term is going to be a bad holding investment for me. It's just one that I have complete trust in for me being in my portfolio. It's one that I think will always be a good holding advantage for me long term. Next stock in my portfolio I'm going to pull up is going to be Alliance Bernstein. That's stock AB. Alliance Bernstein is basically it's a stock that I hold in my Ameritrade account. It's a stock that I hold in my Fidelity account. This is a stock that I just really enjoy because it has proven long-term successful returns, and is one that I am super, super proud of, and one that I am going to keep on investing in long term. It's one that I recommend you guys take a look at. It is a bit more expensive than most other financial service companies out there, but it is one that proves and works long term. I have 5 shares in there for a holding value of about $135. Pfizer, I don't have very much of a holding cost in there. I only have 2 shares of Pfizer for $41.09 right now. $82 is my total equity with them. Really good company as far as just long term. I wish I had a way on the on the. This doesn't work out quite as well as the online version does, on the phone version, where I can just swipe through each individual stock. But we're gonna make it work. Next company on the board is going to be Skis, which is Peak Resorts. Peak Resorts is one that basically, it's not really a great company as far as long term. It's kind of just cyclical. It just kind of floats about and it rises and falls. It rises and falls. I bought them pretty high as far as their cost goes, and they're kind of on a downward spiral. They'll probably recover pretty soon. This is kind of the part of the year where their price starts to recover. If you look at last year's pricing, they kind of start recovering around there. Hopefully I can get it up higher again and then sell it off around the summer. I don't like having too much invested in this company, but it does pay out a dividend sum, so it's nice to have them. They are going to be basically one of those that I try to offset soon. 10 shares valued at about $44 right now. I do have one share of Keurig Dr. Pepper. Basically, I got them after the merger. I thought it was an interesting play. It was one that I wanted to be able to have more of this market in my pocket. Bought one share. Basically, it's worth about $28 right now. It's not a very big holding, but it is still part of my portfolio overall. I do have 2 shares of NL Chile, which is basically a Chilean oil and gas company. They pay out a small little dividend. They're not really the biggest holding the portfolio. Again, only about $10 in value in the portfolio, but been enjoying them. It's one of those that helps me be able to keep an eye on foreign markets. One share of Coca-Cola valued at $49.05. This is basically, it's Coca-Cola. It's one of the biggest companies in the world, one of the most recognizable facial brands. It's one that I continue to want to hold more of in the future. Might start buying more of if they ever fall back. I don't really want to invest in them at $49 a share. 2 shares of Vivint Solar. Basically bought them at like $4 a share, $4.70 a share. They've gone up ever since then due to people trying to, again, capitalize on solar energy and whatnot. And as solar energy and renewable energy resources become more and more valuable, this could become more and more viable over time. It's a very cheap stock. It's a very stock that really doesn't have a great balance sheet, but overall could be one that's great in the future. We will see. We have 2 shares of Seadrill Partners. Seadrill Partners has basically fallen off a cliff. This is one of those oil and gas trust companies that I thought was a great resource back whenever I invested in it, but it has basically fallen off a cliff. Thankfully, I never had very much money in it. I only had about $7 in this company, period. Mainly because I didn't like too much about them, but I still wanted to get involved with them on my balance sheet, and basically I was so thankful I didn't have very much in it because, as you can see, this one has been a landslide company. Now, a lot of companies landslid around the end of the third quarter, start of the fourth quarter last year due to the market overall restructuring, but this one never rebounded, and because of that, they've also cut a lot of their dividends, cut a lot of their profits, and this one is just one of those that now it's so low in cost that I'm just going to keep it in the portfolio in case it ever does rebound, because at this point, my cost being $144 at this point, it's just not worth me selling it. Let's move on. I do have 10 shares of ADT. ADT, of course, as you may or may not know, is a security company in America. This company is one that I'm very excited about long term. I believe that this is a company that could end up getting bought out by a larger company, a company like an AT&T or a Verizon, a company that that is bigger than them, that is more diversified than them, and then tries to buy themselves into more and more and more different industries. ADT is a company that has fluctuated in its value quite a bit. It's one of those that definitely can hang around $9 a share at sometimes, but more or less fell down quite hard back around March. But at the same time, it does go up and down in value, so it is cyclical in its nature, and it is one that I think long term is a good holding strategy just to see what happens long term. They do have some income problems to look into, but they pay a small dividend, and they're a company that could possibly get bought out at some point by a larger conglomerate company. So it's one that I would recommend taking a look at. Next company on the board is going to be Fitbit. I do hold shares in Fitbit. I don't want to hold shares in Fitbit, but it's one of those that essentially I'm holding it just until it can get somewhat closer back to its original value, and then I'm going to sell it. I don't want these shares in my portfolio. This is one of those that I bought them basically because I was like, oh, I have $35. Here's $35. Yay, throw it away. Because I'll do that occasionally if I feel like there's a possible reward to the risk. I did that with Fitbit. Fitbit, of course, as you know, is basically a health consumer goods company, basically making watches, products to go along with your smart gear. And honestly, they're kind of like Yeti, in my opinion, where they just make a luxury one-off purchase item that really doesn't do very much for you in the long term as far as renewable purchasing, which I like renewable purchasing. Renewable purchasing are subscription-based products. They are products that you buy over and over again. Things like Netflix, things like wireless service, things like garbage service, things that you, whether you want to or not, will renew their products. Internet service. Fitbit's not one of those. I want them out of the portfolio as soon as possible. Do not invest in Fitbit. Um, Next one is Wendy's Arby's Group. I like Wendy's Arby's Group. I've liked them for years. I owned them in my original portfolio, which is with Ameritrade. I've had them for a long time, back when they were the Wendy's Arby's Group. They are a great company as far as being one of the smaller companies in the fast food market, while at the same time still being aggressive and trying to grow, while at the same time still paying out a dividend that has been growing over time. Recently, this past year, actually, they grew their dividend. Their dividend is still very small, mind you. Their dividend was at one point, I believe, is 8 cents. Is 8 cents a share. It has gone up to 10 cents a share, which is a huge dividend jump if you really think about it for a company like this. And anytime a company builds their dividend, that's usually a good sign. It means that the company is basically either A, trying to pay out investors a bit more, or is just basically doing things more for their investment holdings. Sandridge Permian Trust. Now, Sandridge Permian Trust has taken a huge dip in the past couple back like week or so, and so it did go from being a lot better to a little bit worse. They lowered their dividend than what it should have, than what we expected it to be. Normally, we expected it to be about 11 cents a share. It's now going to be like 8 cents a share. So the company did drop in its valuation a little bit. It hasn't quite recovered yet. Honestly, it probably will recover. Big reason why the company dropped its dividends, because it was planning on holding more cash in reserves in case of X and Y, which is always kind of a scary thing to say out loud, but at the same time, honestly, the dividend payout on the stock is still so great. We're still looking at like about, if you continue, about 8 cents a share per year, you're looking at about 24 cents a share, which is roughly about a 10.2% payout per year for a company valued at $2.22 a share. That's awesome. It's really easy to get into. It's one that I'm not at all scared about. It's one that I've held for quite a while, and honestly, while I haven't grown my holdings in there, it's one that I've been totally okay with having shares in the company, simply because of the fact that at the end of the day, the company pays out, and the company pays out well enough for me to keep on coming in there, because it's a royalty trust company and they do their job by paying me out. Next company is going to be Plug Power. I do have 5 shares with them. Valuation currently at $12.60. I bought them back at $186. I should have bought them a lot more whenever they were really down, because there was a period where this company was way down back during the huge drop-offs. I mean, we got all the way to like $1 back in December. And honestly, I wish I would have gotten in hard back then, but I didn't have enough faith. It was one of those where it was like, well, it's cheap enough now to where I'm just going to leave my shares in there and just see what happens. And honestly, it bounced back so hard that I really wish I had been hardcore in there, so I could have done a huge cash payout and then pull out. I didn't. Oh well. But it's one that I'm going to hold for the longer term. This is Plug Power. They are basically a manufacturing auto good company that is more invested in the growth of electric cars or electric products out there in the marketplace. Because of that, this is a company that I think long term has a huge growth side potential, and I think could be interesting in the long run. If you don't at least have like $5 invested in them, at least put like $5 in them, just so that way, even if they go down, you're not mad about it. But if they do go up, you're gonna be like, yes, okay, at least I got involved in it before it was still cheap. Because there's nothing worse than looking up 20 years from now and going, damn it, I missed out on the big one. You know, Chesapeake Oil and Granite Wash Trust is another one of these oil and gas trusts that I like very much. This one isn't as sexy as a lot of the other ones, but at the same time is still a little bit more of a cost risk because it is a lower price one. At the same time, I've been very happy with my returns on it long term. It's a company that's been pretty much stable in its pricing. There was, of course, again, everything was down from November to December. Everything in the marketplace was down, so at the end of the day, a sinking ship drags down all the boats. A rising tide raises all the boats. And so whenever it was down in those periods, it was one of those where I was like, dang it, I should have bought more into this company because everything was down at that point, but I didn't. But anyway, long term, excited about the holdings. I have about $43 in this company. You know, it isn't my biggest overall holding of shares. I only have 30 shares. Another company that I've been enjoying is ZTE. ZTE Communications are the cheap cell phone manufacturers. I work with ATT. I'm an ATT authorized retail partner right now. And one of the things about last year's, I really enjoyed using ZTE phones to make sales, quick sales, because their phones are super cheap and they're decent for what they are. They're cheap phones. And honestly, I was so happy because about when I bought into them about $3 a share, they have booned up And they boomed up mainly because they announced a big time around right here that they were going to be one of the big time players in the field of manufacturing for 5G entertainment. So 5G is the new revolution in smartphone technology, and they are going to be one of the first, one of the big time leaders in innovation worldwide on 5G evolution. Which 5G evolution is supposed to be the next big thing to be able to make it to where the world has better or functional internet services. So that being the case, I think ZTE is a great play long term. I only have one share in there, valued about $6.60. ATT. Again, I do work as a partnership for ATT. That is my job, and I've been very happy with what I see in the stock. It recently raised its dividend by $1 a share. 1 cent a share, just so you know, is a huge dividend bump when you're as big a company, as old a company, as functional a company as ATT. Anytime you see dividend growth, it is a interesting or good thing. Some folks have been bashing on the company, going like, "Oh, well, they can't sustain it. They can't sustain it." That's a terrible idea, because there's a thing about ATT. ATT is one of these companies that honestly has so much residual income every single month that they're never going to basically run out of money. I mean, granted they have a lot of things to make up for. They don't really treat their customers very well. They keep on raising their prices. They need to change that long term. They need to change that. They are about 10% of my portfolio right now. I do have 10 shares valued currently at $310, and they are paying out dividends to me, which is awesome because it does help grow my portfolio more steadily. Basically, the 3 big dividend payouts that I have right now, 3 big individual payouts. I have 4 really big individual payout companies right now. That is going to be ATT, Permian Sandwich Trust, Ford, and then Prospect Capital, which you'll see in a little bit. We're coming close to the end of my portfolio right now. Of course, I have 1 share of SiriusXM Satellite, valued at $5.83. It was a free one that I got from Robinhood. Just decided to keep them because they actually are paying out dividends on that. Huntington Bank shares, I have 1 share valued at $13.87. Just a little cheap bank to have in the portfolio. Nothing too special. Iron Mountain Research. Now, Iron Mountain Research, if I had more money right now available, I would totally buy more into the company. They took a huge dip this past week, and that was a huge dip. From about $36 a share all the way to about $33, and then all the way to $32 a share. That huge dip was something that I wanted to buy into, but I really didn't have the capital available right now because I only basically put about $200 a month into this portfolio, just because. But I have 10 shares right now of Iron Mountain. I would love to buy more into this company because basically they were a hard business services company, like a hard data business services company, but they basically changed themselves to being a cloud-based storage software company, which was a huge smart move for long term. And they basically elongated their business model and adapted their business model to make things work for them long term. Great company, great dividend payout, about 7.8%, even higher now that their stock dropped. Go ahead and get in on this. Disney. Disney's been going crazy since they announced their streaming platform, Disney Plus, and honestly, it deserved to go so. It's pulling back a little bit right now, which is probably a good thing because it was on a super hardcore terror, and it pulled back a little bit because it got all the way up to like 142 at one point during midday trading about a day ago. And honestly, I bought them at 109 about 2 months ago. Actually, honestly, was when I bought them, and it's been awesome. Yeah, I actually bought the share back in February 14th, and it's been from 109 to 140. If I was a trader, I would have already pulled profits off the table and gone on to something else, but I'm not a trader, I'm an investor. So, being an investor, you stay in there and you enjoy it. I'm going to enjoy it long term. Disney's a company you need to be a part of. Last holding in the portfolio is something that I'm really excited about. It's a company that I basically learned about from watching Bruce Wang's videos, and then I basically researched on my own, and I really enjoyed it. Prospect Capital. Guys, this is a company that's great for your portfolio. Simply because of the fact that the average cost of it per share is very low, so you can get in on it very quickly, and it pays out a monthly dividend. A monthly dividend is a huge thing for you to have because it's recurring every single month. And so right now, last month, if you look on this is awesome because while you're not getting huge dividends every single month, instead of just like one big dividend every single quarter, you're getting small dividends every single month. So like back in March, I only had 4 shares recorded for March, 24 cents. Okay, not very special. April, 20 shares on file. Got $1.20. The May dividend, I have 60 shares recorded. I'm getting 6 cents a share, the same exact number of dollars per share. $3.60 in May. And this is recurring every single month. So as my holding in them builds, I'm getting more and more money every single month into the portfolio. This is going to make things just a lot healthier long term and be able to help me build up the wrecking ball that is my portfolio. Because that's the idea about your portfolio. Your portfolio should react and behave a lot like an avalanche. An avalanche, remember the old image of the avalanche where basically it's a small ball of snow that as it keeps going downhill, it builds up more steam, it builds up more steam, it builds up more steam, and then becomes a giant wrecking ball that destroys entire cities. That's the idea that your portfolio wants to have. And basically, companies like Prospect Capital that are putting out monthly dividends are going to help you get it. Get involved in Prospect Capital right away. That's my portfolio right now on Robinhood. This is my Robinhood portfolio. It isn't the biggest thing in the world. It is one that I keep on wanting to grow into. But I hope that you got some healthy tips and research. If you want more information about my portfolio, let me know in the comments below. Thank you. Have a wonderful day.